So today we are going to discuss Maithon alloys, and of course, this is what we are going to discuss in today's presentation. So we'll start with the history of Maithon, and then we'll get into the business model, financial performance, the industry trends, what are the growth drivers of this particular company, what are the risks associated with this particular investment, and of course, we'll end the presentation with the valuation. So, what exactly is the valuation of this particular stock? So, we'll end with that. So, starting with the business model. So, it's Maithon Alloys. So, let's look at how it makes money. So, through ferro alloys, as the name suggests, it is Maithon Alloys. So, uh, the product is basically ferro alloys, which is an essential additives in steel making. So you need to understand it helps in making steel, which will improve the strength, corrosion resistance, and the durability of the steel. And the key products include manganese alloys, silico alloys, and ferromanganese. Now, if you look at who are the customers for this particular business, so major customers, if you look at Indian players, Tata Steel, SAIL. So these are the major customers from India, and of course they export a lot to Europe, US, and Middle East as well. Coming to the production capacity, so 3,32,500 metric tons per annum is the manufacturing capacity of this particular company, and mostly they have plants in three locations. One is West Bengal, the other is Meghalaya and Andhra Pradesh. So these are the three locations where they have the manufacturing plants. And coming to the revenue mix, now this revenue mix is very important. So as of 2000, as of the current numbers, domestic sales is 44%, export is 56%. Now they have global customers across 40 countries. So they are exporting not just to US or Europe. So total global customers, it's like 40 countries. And this number is very important, which will help us in terms of valuation as well going forward. Now, if you look at the growth drivers for this particular stock, so first is steel demand and infra growth. Of course, steel and infra, basically they are all uh, are the major growth drivers. So India's steel consumption is rising and pushing demand for the ferroalloys. Now this is the long term demand. Of course, steel is a pretty cyclical commodity end of the day. So there will be cyclicality in this industry. And of course, that is the reason we are also interested in Maithon alloys, because of the cyclical nature of the business. And government projects like, let's say, railways, roads, real estate expansion, infrastructure will also drive the demand for this particular stock. That is the first aspect of growth. The next aspect is basically export expansion. Now, China plus one strategy also helps Indian manufacturers gain global market share. So, Maithon increased export to 56%. I mentioned here as increased, but when we actually go and look at the sales, this mix has actually reduced. Right now, it is 56. Last year, it was much higher. And debt free balance sheet. So we'll get to this. So 2200, but we'll get to this particular number. So they have got a lot of investments on the balance sheet, a lot of cash and investments. And of course, operating efficiency and cost control can also be one growth driver going forward. So integrated procurement and logistics can help manage the raw material cost. So like I said, steel is a commodity. So any company that can optimize the cost structure will have an advantage. End of the day, you cannot have a brand or switching cost or network benefits with this business. What this company can have is cost advantage. So through integration, it can be backward or forward integration, and logistic is one big line item on their expense, one big expense line item. So by cutting cost or optimizing the cost, this company can improve the profitability of the business. Now, steel and infrastructure demand expanding into global markets, a strong balance sheet, operating leverage. Now, these can be the growth drivers for this company. Whereas, if you look at the challenges and the risk, like I already said, steel industry is cyclical. So, the demand for ferroalloys depends upon the steel demand. So if steel prices drop, Maithon Alloys revenues will also drop because it's a commodity. The realization per metric ton will drop. So eventually, if there is a dip in the steel market, the prices for this ferro alloys can also drop, impacting the revenues of the business. Now, please focus on the revenues part. Revenues are cyclical. Next is raw material volatility. Manganese ore, coke prices. These are the basic, input cost, major input cost for this company. Manganese ore or coke. Now, even these prices also fluctuate a lot. End of the day, that is also a commodity, so cyclical in nature. That also will impact the margins. So due to the cyclicality, sales of the company will also impact, the margins of the company will also impact, but not structural, it is cyclical. Production cutbacks, like I said, whenever there is a drop in the steel prices, definitely the production will also reduce. So capacity utilization will also drop, and recently from 75%, the capacity dropped to 60% in the first half of 2025. Right now, this company is cutting a lot of its capacity. Why? Because of slow demand. So demand dropped, so capacity utilization also dropped, which will again impact the sales and the margins. Now, how to mitigate this particular risk of cyclicality? Focus on cost efficiency. Revenues or margins are not, revenues fluctuate. At least you can cut cost or optimize cost or value added products to sustain margins. One, you can improve the efficiency in terms of cost and improve the margins, or you can add some value added products where the margins are little higher in protecting the or sustain the operating margins of the business. Long term contracts with customers for stable revenue visibility. Of course, they can get into contracts, long term contracts with a certain price that can also have them a sustainable revenue figure and margins figure. Now let's try to evaluate the sales growth. So this is the story part. I hope you understood what exactly they are doing right now. So it's a commodity business, end of the day. So I hope you can see the screen. Let me check. Now first, if you look at the sales of the business, 950, 1100, 1300, 1800, 1900. You can see there is a lot of growth that happened in this 5 years when the steel demand was really good. But look at 2020, revenues dropped. 2021, again revenues dropped. But what happened in 2022? Again, capacity utilization play a role here. Whenever the capacity utilization go down, the sales will also go down, steel prices go down, the sales will go down. So that's what happened here. Immediately in the next year, the capacity utilization also went up. The prices for the steel in the global as well as domestic market also went up. So as the demand came in, you can see the sales doubled immediately, which is almost 3000 crores. And recently again, the sales dropped like more than 40% drop in sales. So if you look at the recent numbers, from peak, the sales dropped by almost 40%, from close to 3000 crores to almost 1500 or 1700, close to that. Now, if you look at the key reasons for decline in the revenues, first is the sharp drop in the ferro alloy prices. This I already mentioned. If this ferro alloy prices drop, the revenues will drop because of the realization. So steel industry slowdown globally impacted the demand for this product. And of course, the prices of manganese also dropped. Significant drop. So more than the decline in the raw material cost, leading to lower realization. So since the raw material price dropped, now you need to understand this is a commodity. End of the day, the customer is going to purchase based on the current market price, not at the purchase price. So they might have paid a little higher price while purchasing that product, that commodity. But if the current market price is much lower than that, they have to sell it at this price. So lower realization. So that is the first reason for the drop in the revenues. Second is decline in capacity utilization and planned shutdowns. Like I already mentioned, when the demand itself is lower and the prices are also dropping, there is no point in increasing the supply. So they have to control the supply also. So what they have done is they have reduced the capacity utilization. So they are not working at full potential. They halted. They have closed some plans also to reduce the capacity utilization. So Impex Metal and Ferro Alloy plant shutdown happened around in 2023 due to high power cost and lower realization, reducing the production. Now this is their strategy, because lower realization and higher cost is anyway, it's a game they'll lose. So they don't want the production to be at full scale, so they dropped it. Next is Kalyaneshwari plant running at only 50% capacity from July 2024 due to again weakness in the demand. So overall capacity utilization fell from 83% in 23. Now what is the 23 numbers? You can see this. 2,883 crores they have generated with 83% capacity utilization. And if you look at the current numbers, it is only around 1800 with a capacity utilization. So as you can see, from 83 they dropped it to 75. Now further declined to only 60%. So right now they are only operating at 60% utilization. Whereas this is 83% utilization, this is only 60% utilization. When the demand comes back, they'll again increase that capacity utilization. Their capacity will be increased and again they can touch a higher number. So what is required here is demand in that markets, in that particular market. Next is export market weakness. Again, it again revolves around the demand. So exports were almost 72% in 2023 when the sales were at the peak. Right now you can see their export revenue is only 56%. So export revenue also dropped. Why? Because of the weak demand and weak price realization. Global trade disruption, lower steel demand in Europe and China impacted their orders. Again, weak demand. Higher power cost impacting the margins. So state electricity tariff hikes that increased power cost per ton, putting the pressure on margins. Next is this made operations less viable at lower realization levels, forcing shutdown of certain plants. So they had to shut down certain plants. Last is working capital and inventory issues. Of course, longer payment cycles from steel companies increase the working capital requirement. Why? Because end of the day, Tata Steel or SAIL or all these companies, they are also facing weakness in the demand. So accounts receivable, so that is getting delayed. So cash is tied up in the working capital. So again, that also reduced the growth. Now what's next for Maithon? So will this sustain forever? So the sales are going to drop forever or they are going to recover? Demand recovery is expected in the second quarter of 2026. So for next 6 months or 1 year, this problem is going to sustain. So that is the first thing the investors in Maithon Alloys should understand. The recovery will happen, but it will take at least 1 year. So in the 2026, in the second half of 2026, we can expect demand recovery. Restarting idle capacity once realization improve. Cost optimizations measure to improve the EBIT per ton. Now you have to understand the major problem here is not regulatory policies or not competition. It's not like that. It's majorly weakness in demand. And this is a cyclical industry. Basically, any commodity, it can be steel, it can be iron, it can be zinc, any commodity end of the day, or any metal for that matter, goes through such cycles. And right now they are at the bottom of the cycle. So what is the takeaway in terms of sales growth? So revenue decline was mainly due to lower alloy prices, plant shutdowns, and export slowdown. And they are all linked with each other. It's not like they are three different problems. They are linked with each other. So the major problem is drop in the prices. A demand recovery in steel and infra projects will be the key for future growth. So once that demand revives, we can see again the growth in the sales. Observe the operating margins of this business. So what is the lowest number? If you look at the lowest number, in 2014, operating margins were at the lowest, around 6%. But again, if you look at the next few years, From 6, it improved to almost 21%. But again, it dropped to 16, it dropped to 13. Again, there was an improvement from 18% to 36%. And recently, it went to 20%, 7%, and right now it is at 6%. Now you tell me, where exactly it is at the cycle? At the peak of the cycle, or around the average, or at the bottom of the cycle? Looking at the long term history of this business, the lowest was around in 2014, which was around 6%, and right now it is close to that long term average. Sorry, it's close to that lowest number. So right now it is at the bottom of the cycle. The sales also dropped significantly and the margins also dropped significantly. So if you ask me where exactly this particular business is in its cycle, I would say it is at the bottom of its cycle. And why should we even invest? Like, is it a high quality stock end of the day? Now, how we will know? Basically, we look at the net profits of the business. So there are years where the company was generating high sales, high margins, and there were years where the company was generating lowest margins and even sales were also dropped. But look at the net profits. Bottom line was always positive. This company always generated profits. In the lowest point of the cycle also it made money. Highest point of the cycle also this company made money. So I would say it's a high quality cyclical business. So we need to understand the cyclicality of this business, and right now it is at the bottom. Now, what exactly are the reasons? What are the key reasons for the drop in the margins? So first is again steep decline in alloy prices. Obviously, the top line itself is disturbed, which again carried towards the margins of the business. So global prices fell sharply, impacting the realization, which means impacting the margins. So manganese alloys price fell more than the decline in the raw materials, so which is squeezing the margins. Next is again power cuts, which I already mentioned. Higher power cost, reduced capacity utilization. So they shut few plants and they reduced capacity utilization from 83% to almost 50%. So they are only running at half their capacity, like 3 lakh something odd capacity they have. So right now they are only manufacturing 1 lakh 50,000 or something capacity. Why? Because of the weak demand, they are not running at their full capacity, which reduce their margins. So lower fixed cost absorption directly hit the margins of the business. Next is rising raw material cost. So coke or manganese ore, coal, these are the raw materials forming 51% of total cost, total sales. The price increased significantly. Supply chain issues and fluctuating import prices also reduce the margins. Lower contribution from exports. Generally, export business they might generate higher margins than the local business, but that higher business, so higher margin business, there was a slowdown which affected their margins. So, global slowdown in steel production led to lower premium prices for exports. Generally, they get premium prices if they export, but export reduced from almost 70% to 56%. So, significant drop in the export revenues, which affected the business, the margins of the business. So, what's going to happen? Is it structural or is it cyclical? Again, the prices need to stabilize for margins to recover. So again, the second half, like we already discussed, the second half of 2026 is where and operational efficiency measures needed. Again, the power cost is basically they are running at half the capacity. You basically run at half the capacity or full capacity. Basically, electricity bill is the same. So if they run at 70, 80 or 90% utilization, that power cost per metric ton will be reduced. So once that demand comes in, the cost will also go down. So what is the final takeaway in terms of margins? So margins also drop due to lower pricing, higher power cost, or reduced plant utilization. Recovery again we have already mentioned in the second half of 2026 onwards, the demand would normalize, the sales would improve, and of course the margins would also improve. So that's the backstory for ferro alloy business, which is at the lowest point of the cycle. But now let's look at the valuation of ferro Maithon alloys. And during the valuation, I will add few more points which will act as an insurance for our investment. So whatever I have narrated so far, this is the business story. Basically, why we have invested in this particular business. But that is only reason number one. We have another reason to invest in this particular business that I'll cover in the valuation part. So first things first, if you look at the revenues of the business, right now this company is generating some 1800 crores of revenues. Now, of course, we are expecting the prices would normalize going forward, the demand would revive, and the sales growth would be positive going forward, is what we are assuming, because there is scope for growth in the business. But I am still expecting a reasonable or realistic number, which is only 6% revenue growth. Only 6%. I am being very much conservative here. I can keep it much higher. If everything goes well, you see here this company generated almost close to 2,900, or let's say close to 3,000 crores of revenue this company already generated 1-2 years back. And if you look at my valuation, the same number this company is going to generate after 8 or 9 years. So that's how conservative I am. So what I am assuming is this company will improve the revenues, but it will take a lot of time. So I am giving it, I'm basically punishing the business. So ideally in next 2 to 3 years, this company should touch close to 3,000 crores of sales. But I am saying not 4 years or 3 years, it will touch in 8 years. So that is over conservative, but I am like this. I am very conservative in terms of valuation. So I am just giving it a 6% growth rate. And of course, the terminal growth rate is somewhere around 4%. So if you look at that number, the overall 10-year growth CAGR we are assuming is only 5.4%. Next 10-year growth we are assuming only 5.4% in terms of sales. Why around 5 to 6% is because if you look at the last 10 years of growth rate, if you look at the last 10 years, the sales growth was somewhere around 6% for this company. You can see here. So around 6%. 948 to 1800, that is doubled in 10 years, which is close to 6%. But if I calculate instead of 10 years, if I calculate, let's say 8 years CAGR and I take this number, then 900 to almost 3,000 crores in 7-8 years, that will be 10-11% or even 12% CAGR. So I can give it a 12% CAGR also, even that also is a reasonable number. If I put that number, within 4 years, the company will generate almost 2,800 crores. So this is also possible. I can keep this number, but I am being conservative. Got it? That is the revenue assumption. I'm just giving it last 10 years of growth rate. Next is the margins. So the long-term margins of this particular business is around 16.5% or close to 17%. The last 10-year long-term average is close to 16.5, 17%, but I am giving it a 15%. So what I am expecting is right now the margins are somewhere around 4.6, 4.7. But of course, this is at the bottom of the cycle. In the peak year, it generated 30-35% margins also. But what I am assuming is eventually the mean reversion will happen. There will be revival and it will go towards 15%, which is the long-term margins. 16.5 is actually long-term, but I am again being reasonable here. So I am only expecting 15% is what the target would be. Next comes the marginal tax rate of the business, somewhere around 25%. So marginal tax rate in India. Next is the target sales to capital ratio. For every rupee that the business is investing, how much sales they are generating. So if you look at the long-term average, it is somewhere around 2.68 is the current number, 2.72 is the long-term average. So somewhere around 2 to 3%. So what I have done is I have taken the long term average, which is current number is also close to this current year number, and long term average is also more or less the same. So I have given it a 2.7. Next is cost of capital. So generally we take 12% as cost of capital, but why I am giving it 11.31 is because around 50% they are generating from India. The remaining 50% is generated through United States, which is US, Europe, and of course UAE. The cost of capital in India is higher than the cost of capital in US. So since this company is generating more than 50% of revenues from global markets, so that revenue is more safer than the domestic revenue. So we have to reduce the cost of capital a bit. So that's what I have done. I have adjusted that. So instead of 12%, so we are taking it, we are taking 11.31 as cost of capital. Next is again the terminal growth rate. 4% is what we are expecting. Okay, terminal cost of capital again. After 10 years, of course, the business will mature. So the cost of capital will be much lower than what it is today. So after inputting all the assumptions, you can see here. So let me remove this 1 second. So after inputting all these numbers, what you can see here is 820 rupees per share. It is overvalued, right? You can see here the company is trading around 18% premium to its fair value. But let's improve. So there is scope for improvement in revenues as well. So instead of 6, what if the company can generate 12%? That is close to 10% sales growth in next 10 years. So then the business is 10%, close to 9% margin of safety, you can say. So as you can see, that's the range. So the lowest would be somewhere around 820 and the highest would be somewhere around 1000. So if you do this, what you will realize is, okay, even if I change these numbers, I'll be aggressive or I'll be conservative, more or less it is close to fair value. It's not like share price is 900, value per share is 200 or 300. More or less, if you change some assumptions, the number will change. So I would say mostly it is around fair value. Now your question would be, then why you have recommended this stock? Because more or less Maithon is trading only at fair value. What is the point in investing? Without margin of safety, significant margin of safety, we don't invest in such stocks. Then why I have recommended Maithon in our portfolio? The reason is, whatever we have covered so far is regarding the business. But there is one more hidden asset. Focus on the investments of this business. September 2024, which is the recent filing, this company has got 3,374 crores of liquid investments. Of course, not 3,374. In that 3,374, around 60 crores or let's say around 70 crores is non-current investments, which is not liquid. They are non-current investments. But 3,300 crores are liquid investments. Mutual funds, liquid funds, some investment in FD, so some debt funds. They're all liquid funds. End of the day, they can sell their mutual fund units tomorrow. They can liquidate their liquid funds tomorrow. So almost close to 3,300 crores of liquid funds on the balance sheet. Not just that. If you look at the cash, they also has got 44 crores of cash. So if you add up all these numbers, here you can see non-operating long-term assets have already included 74 crores. But you take 74 from here, remove that 74, 3,300 plus 44. So the cash is 3,344 crores. That is the cash that they have got. Liquid cash. Chalo. If you add that, then the value per share is close to 2,000 rupees. So this is also a buy one get one free kind of an offer. If you are buying their mutual funds, you are getting the entire business for free. If you are buying their business, you are getting close to 3000 crores of their mutual fund assets or liquid fund assets almost for free. Current market cap is also 2800, which is less than their liquid funds. I have made a small correction here. So 3344 crores, I don't want to put that number. Why? Because it somewhere around in September. And you know what happened after September? There was a huge fall in the equity market. So 20%, 30% drop happened in the equity market. Of course, they have not invested every rupee into equity mutual funds. They have got liquid funds also. But having said that, I want to be a little conservative here because I don't know the current number. I am assuming the value of their investments might go down because of their equity holdings. A part of their equity holdings will go down 20-30% because in the last 4-5 months, generally portfolios also fell down by 20, 25, 30. With some portfolios, they were almost 40% drop. So I want a discount here, but not 2000 or 1500 because they have got liquid funds. Liquid funds won't drop. So I am assuming the value might go towards 2500 crores, which is again close to their current market cap. Close to their market cap. So what I am assuming here is the total net equity value is 4885. Let's say 4900 crores. In that 4900, 2500 is their liquid funds or their liquid assets. Remaining close to 2500 is their business value. So if you are investing in Maithon, just remember this. If you are paying for business, you are getting all these investments for free. If you are paying for these investments, you are getting this business for free. So buy one, get one kind of an offer we are getting with this stock. And as you already know, the market is falling. So this would add a lot of stability in the portfolio. So whatever happens, you will not lose money in such investments because there is some safety cushion here. They have got liquid funds. So that's the safety. Even if the business is gone, your money itself, what you are paying is much less than what they have in the bank. So that is what I